Our next guest says he doesn't think this correction has run its course, but he also doesn't expect a new bear market. Joining us right now is Sam Stovall. He is Chief Investment Strategist at CFRA Research. I think, Sam, we're all trying to make sense of what is the move, if you will, and how you see it.
Good morning, Andrew. Well, certainly there is so much uncertainty out there that investors are saying, let me sell first and ask questions later. But when you look at the magnitude of the decline, the number of days that it's taken to eclipse that minus 10% threshold, with all of the uncertainty that's surrounding us, in many ways, I'm sort of surprised with the orderly withdrawal, if you will, from the equity market. So my implication is that we probably will see a deeper correction before all is said and done. But I'm not really looking for a bear market, or if one does occur, it's likely to be fairly shallow.
You know, we've seen obviously some of the big growth stocks, the tech stocks have come off. But at the same time, we've seen even like cybersecurity companies, we're talking about Palo Alto Networks, that is also off. And so the question is, are there companies that are selling off that shouldn't be, and are there opportunities that you're looking at today?
Well, I think many of these companies deservedly have been sold off because they were trading at such extensive multiples. And what we have found traditionally is that there is a negative 0.5 correlation between the 10-year yield and PE ratios. And so when you're dealing with very high PE ratios, it's not surprising to see PE contraction in a rising interest rate environment. But like a boxer who has now been staggered by a 1-2 punch of higher interest rate expectations and now geopolitical activities in Ukraine, then I think that what we're seeing is a continued PE contraction. But I think that now investors probably should be looking at areas that have been beaten up the most, such as semiconductors, such as software, and looking to start to nibble in there. And if you wanted to take sort of a defensive approach, looking at staples and technology is typically a fairly good approach over the long haul, getting about 96% of the return of tech, but less than 40% of the volatility.
Shepard Smith here. Thanks for watching CNBC on YouTube.